On the Express this week, bonjour, ça va, comment allez-vous? It's another melt up rally just for us. Entree new, coming to you live from the Côte d'Azur. December in the south of France. Who would have thought of that? We're going deep inside the charts, deep into the trends with Patrick D from the Chart Report, stacking ends over ends. And then we'll do the indicator and what to watch this week. C'est la Investopedia Express. Ooh la la, so unique. Welcome back and welcome aboard. And yes, we are coming to you live from the south of France. We're in Cannes, France here for the International Luxury Travel Summit with our friends at Travel and Leisure, and the Express goes where we go. So we are live from the Bogart Room. This is my hotel room, the Bogart Room, right here in the Hotel Athénée, downtown Cannes in the south of France. And guess what? It's a melt-up rally, folks. Stocks ending last week, the shortened trading week for Thanksgiving, deep into the green. That's what it looks like. You remember the week before, it didn't look so hot. Looked mostly red. Last week, stocks powering through to end November with a little bit of a rally going into the holidays there. As you can see, some of the biggest stocks getting some big movement there last week. And it's a little melt-up rally. Stocks a little shaky coming out of the gate to start Monday morning here as we start the month of December, the last month of the year, typically one of the strongest months of the year. But you can't deny the fact that the trend has now reversed. Boy, these moves are happening very quickly. Just about a week ago, we were talking about this risk reversal moving the other way. Well, guess what? Things are moving back the other direction. Risk is back on the menu. 5-day winning streak to close out November. Turn November back into the positive. The biggest monthly swing from negative to positive ever for the month of November. If you keep track of such things, just know that was a pretty big swing in just 1 month. And there's been no bigger beneficiary in the stock market than Alphabet lately. That stock surging, getting some momentum. Look at Google, Alphabet, GOOGL, the ticker there, obviously, versus NVIDIA lately. It's a tale of two different investor sentiments right now. Alphabet shares rallying over the past month. A lot of optimism about AI progress, up about 16% last month. NVIDIA down about 14.5%. What are investors so enthusiastic about all of a sudden? Well, the latest Gemini 3 AI model apparently has received positive reception, and that's added to some confidence there. Also noting that's a strong competitor to those of rival companies like OpenAI. So Google making a big move in AI and commercial AI, and that is why the stock has so much wind at its back. And of course, its new AI hardware, the tensor processing units, the TPUs that everyone's all excited about. This is an alternate to NVIDIA's GPUs. And if the TPUs can be used in data centers, then all of a sudden, Alphabet, Google has a new market supplying chips to data centers. And we know how profitable that's been for NVIDIA. But you know what? Stock market rallying, back in rally mode, risk back on the menu again. And that's weird because we got pretty oversold, as we pointed out last week in those good charts from Bespoke Investments. And you know we're oversold when the magazine covers start tackling the problem. When you see oversold conditions or AI in a bubble or could the stock market topple the economy like you do here on The Economist, shout out to The Economist. We love The Economist. Then you know that we might have been in oversold condition because these covers are at least a week in the making, and they don't come out until the problem's already been well announced to the rest of the world. And we were oversold, absolutely. So also, we talked about last week, Greg Gibbs' fantastic column in the Wall Street Journal about the rally that everyone seems to hate right now because it's been powered by these AI-related stocks, and AI might eventually upset the economy and take a lot of people's jobs. So it's a rally that's been good for investors, but bad for the sentiment of consumers, bad for the sentiment of workers who feel like the job market's going to get a lot weaker, and consumer sentiment, as we know, at a multi-year low. But maybe the rally has something to do with the fact that investors are getting excited about lower interest rates on the horizon, right? If you look at the CME's Fed Watch tool, and I look at this all the time, the chances of a little baby cut coming up here at the December meeting have risen dramatically over the past few weeks. New York Fed President John Williams last week indicating that maybe we do need a little baby cut before the end of the year to stimulate the labor market. And that has investors pretty optimistic that we might get yet another rate cut, a quarter point cut, a little baby cut before the end of the year. But then you know what's going to happen. We're going to get lower rates into 2026. And maybe investors are enthusiastic about the fact that the president has promised potentially to name his Fed chair candidate by Christmas. And that the leader in the clubhouse there, the Fed chair candidate to be potentially Kevin Hassett, chair of the president's National Economic Advisors Council right now, very close to this administration and very dovish. And guess what? When you get dovish Fed governors and Fed presidents controlling interest rates, you get lower rates, and lower rates can be a stimulant for stocks, especially if the economy is in decent shape right now. When the economy is in much weaker shape and you get a rate cut, not so good news. But that's why investors may be optimistic right now. A lot of things going on right now that's pushed risk back in the other direction. And as the great MC from RC Projects and Bed-Stuy likes to say, men lie, women lie, numbers don't. And when it comes to our capital markets, price, my friends, never lies. That's why market technicians love it. And no matter what the headlines say, the charts tell the real story. No one is on top of that story more than my friend Patrick Dunuwila, the co-founder and editor of the Chart Report, a popular technical analysis newsletter read by thousands of investors worldwide every day, including me. I never miss an edition of the Chart Report. Patrick joins us on the drop-in a couple seconds. Welcome to the Express, my friends. About time. It's really good to have you on the show.
Caleb, thanks for having me. Glad we could do this.
I'm a daily reader of the Chart Report and all the good things that are coming out of stock market media and stock market TV. You guys put out such great work. So I know you got your finger on the pulse of what's happening with traders, especially day traders and crypto traders and people who trade on price action. What's the vibe right now? What's the feeling out there?
Yeah, I mean, as far as sentiment, as you mentioned, it's been a choppy few weeks. So, it's kind of hard to get a solid read on it right now. And kind of reminded of that Walter Deemer quote. I mean, Walter Deemer has so many great ones, but he says, if you need an indicator to tell you that sentiment's at an extreme, it might not be. Or it's probably not. And as we know, sentiment is most useful when it's at those extremes, when everybody's really bullish or when everybody's really bearish. So right now, and of course, sentiment works in kind of different time frames too. And I love this chart you have here because it kind of brings it back to the bigger picture and where we're at in terms of like the longer term sentiment, in that longer term context. And I think with the kind of drawn out bear market in 2022, and then that sharp near bear, or if you want to call it that we had in April, people are still reluctant to really embrace this rally. Yes, the S&P's up, about 18% almost year to date, but then you look at things like small caps, RSP, I think that's a better kind of depiction of your average portfolio out there, and maybe why you're not seeing that euphoria just yet.
Yeah, shout out to our buddy Ryan Dietrich, who threw this chart out there from AAI, the sentiment survey, and that shows, pretty bearish despite the fact that we have had a 18% rally year to date. It's been choppy, hasn't been a straight line up, but it never is, and that's the price we pay to invest. So I know you follow a lot of people who are trading all different types of instruments out there, all different types of assets in the capital markets to trade. What's getting sort of that buzz inside the chart report and among those you follow throughout stock market media that no one's really talking about in the headlines? You don't see on business news TV, or you don't see us writing about it that often. I know there's some obscure securities out there that are getting people's attention.
Yeah, I mean, as far as stocks go, healthcare definitely been a big area recently. It's the best performing sector in November, coming off its best three-week outperformance relative to the S&P. It's second best ever, and its best 3-week outperformance since 2020 or 2002. So that sort of momentum thrust, even on a relative basis like that, you often see that at the start of kind of a longer term trend shift. So, and you tend to see a cluster. We've seen a couple, but healthcare really showing signs that it could be a leader next year. And of course, it was really weak in the first half of the year. It was weighed down by UNH and a few others, and But it's been the leader in the second half, and a lot of areas within healthcare, whether it's biotech or medical devices, look really good right now. So that's an interesting one. But as far as kind of the less obvious ones, in my circles, silver has to be one of the big ones. Not too
Record
many.
highs. Record
Right,
highs for
right.
what they call the Demon's Medal, and they call it that just because it's cheaper than gold. But I think that's a mean name for that metal, and we're going to talk about that a little bit later in the show. But talk about indicators and momentum. How about one of our favorites, the Zweig breadth thrust indicator? I know you love that one. Shout out Marty Zweig, one of the great market technicians of all time, Hall of Fame. What are you seeing there? What does the trend tell us when we see one of those? What is it, and what does it tell us when it happens?
Yeah, so I mean, it's really kind of the calculation uses I think 10 period moving average of the advanced decline line, but basically it's telling you a big thrust in participation, and that's typically what you see in the early innings of a bull run. What's really interesting here, though, is that we've seen, I think, 3 or 4 since this bull market started. So you're seeing them kind of more frequently than you usually do. But the track record really speaks for itself. I think we got the previous one was in April, and a lot of doubters then, but they ended up kind of eating their words there. When you see something work over and over again, you start to get a little nervous. Is it going to continue holding that streak? So we'll see. But this is definitely not. It's definitely not been a good idea to fade this sort of signal out there.
For those not watching us live on the streaming platforms, we're looking at the S&P 500 when the Zweig breadth thrust indicator triggers, and almost every time that has happened, the stock market has been higher 1 month later, 2 months later, 6 months later, a year later. So it is a momentum indicator. And the key word there, Patrick, right, is breadth, which we love in the stock market. We don't love it when 10, 20 stocks are rallying. We like it to see when we have full participation, like a good basketball team out there running the floor with everybody getting some points, everyone getting some touches. Let's talk about this confluence that I'm obsessed with lately of trading, sports betting, crypto, DeFi, Polymarket. Polymarket was on 60 Minutes last night. Everyone's talking about their prediction markets and all these markets kind of slamming together at the speed of light. I know this is manifesting out there in trader land. What are you seeing, and what do you think is where do you think this is headed?
Yeah, I do think it's really interesting to see kind of the trading crowd on Twitter, at least, embracing, and trying to take a very statistical approach to those betting markets, because I think, if you are controlling risk and reward, I'm sure there's a way to do it. I haven't personally really looked into it too much, but it is interesting seeing people kind of approach it that way. I think it is, the growth has been really incredible of that market. And I think in some ways, it's a more direct way to kind of hedge event risk if you really wanted to, hedge an election risk or something like that. So I think it'll continue to grow. I do think there's a tremendous amount of potential for bad acting in it, in influencing the outcomes of things. And something like an election is kind of harder to throw or more scandalous, but something smaller, like, is Powell going to say
a professional basketball game potentially?
Right.
Yeah,
Right.
exactly. You know what can happen once you get the prediction markets involved. But in this world that we're sort of heading into, where crypto trades around the clock, around the world, we're getting to this 24/6 exchange coming out of Texas at some point next year. Private markets are opening up to individual investors into our retirement plans, as is crypto. How do you see all this playing out? How does it manifest, especially as a younger person looking at the world of trading right now in the world of the capital markets, where a lot of people believe that they're going to try to make some, get to their retirement through investing or trading? How do you see it playing out with your cohorts?
Yeah, I mean, from the people I talk to, I think the sentiment towards the whole move to 24-hour, I think most traders, you'd think that maybe like more immediate access would be a good thing, but most are like, shut it down for a little bit. You need a break. You need a couple days. You need some time. The weekend's always kind of a good time in stock market land to kind of just pause and look through the charts, and you know, get a fresh look at things without all the chaos of the week going on. So it is definitely challenging, but it's one that, you know, you find ways to kind of get around, or, you know, you kind of fit your time frame to adjust for that too.
Yep. All right. Last chart. Let's get to Bitcoin here, because Bitcoin has got its own little trend going on right now. And it's a downtrend, down and to the right. But those
Sure
of us
is.
that have followed Bitcoin for as long as it's been out there know that, hey, 25, 30, 40% drop is nothing
Right.
with this volatile securities. But what do you see? What pattern is that actually that I see? It looks like a razorback to me, but Bitcoin getting pummeled so far just in the past, I don't know, 6 weeks or so.
Yeah, I mean, it really started with a failed breakout, and around that one, I want to call it 125 level, and just breaking every single trend line in sight. And you know, trend lines aren't the end of the world, but it is signaling a loss of momentum. And I can't think of an asset where momentum is more important than Bitcoin, because, you know, we can talk about all the different uses, but at the end of the day, right now, speculation seems to be the biggest reason people buy Bitcoin. And why would they buy it? Why would they speculate on it? Because it's gone up, because they saw their neighbor get rich off of it, and things like that. So the fact that you're not seeing that, and the longer that takes place, the longer people aren't making money off of it, and you're seeing alternatives like gold and stuff just absolutely flying. That's really damaging, I think, for it.
Yeah, so I think it does have a psychological impact for sure, and it is, you know, subject to the greater fool theory, like a lot of securities out there, but especially Bitcoin, because there's nothing really backing it except what you and I think it might be worth today or tomorrow. All right, let's go on this. One pattern or chart you're fascinated with, looking into the end of this year and going into 2026. What's one we should focus on? Teach us, technician, what we should be looking for, because we're going to check in on it every few weeks or so as we head towards the end of the year.
Yeah, I kind of teased it earlier, but silver. I mean, that one to me, I don't know if your audience is familiar with the term fractal, but, like, you know, think about a piece of broccoli, right? A big piece of broccoli. You rip off a piece of it, and the little piece that you just ripped off looks a lot like, or almost exactly like, the whole, right? And that's kind of what's going on with the silver chart. If you start off in like a 2-hour time frame, you'll see like a 1 month cup and handle, and then you zoom out further, and then there's a 14-year base and a cup and handle forming. So it's really just bullish pattern, and just in multiple time frames, and breaking out in multiple time frames like that. So whether you're looking for just a quick flip, or you know, tucking this away under the mattress, I think this is a really interesting spot here for silver, and it's starting to outperform gold too. You saw the silver gold ratio break out to a four-year high last week. That's showing just risk appetite for precious metals more broadly. So right here you have silver, the ETF, breaking out of what is that, like a 13-year base or something like that. But if you actually look at silver spot, this giant base here is really the handle of a much larger cup and handle pattern, dating all the way back to when the Hunt brothers tried to corner the silver market in 1980 there. So this is really a historic breakout, and it's surged the last couple of days, so you don't want to chase something like that too much, but this is really a longer term breakout at play.
Yeah, that is classic cup and handle there. And the bigger the base, as you technicians like to say, the bigger in space that it will rise. Patrick Dunuwila, the founder and editor of the Chart Report. Folks, subscribe to it. Follow Patrick on the socials. He's always got good stuff to share. And he's following, like me, some of the smartest people out there. And he is one of the smartest people out there when it comes to tracking this market. So good to have you on the Express, my friend. Thanks for being here.
Thanks for having me.
All right, let's get to a little money in motion. And Patrick alluded to it. It is silver. It is the chart of the week that we're paying attention to. Let's check it out. All right, silver prices at a record high as of Friday, surpassing the peak set before the squeeze back in October. Big squeeze in the silver market, in the London silver markets back in October of this year. Spot prices up as much as 4.2%, around 55, 56, 58 bucks an ounce now, supported by fresh hopes of investor hoping for a rate cut in December. We spoke about that. A rate cut, lower rates could be beneficial for silver as well. Also, inflows into exchanges, ETFs, and other products that hold silver or that trade off of silver as a spot currency. Those have been very, very substantial lately. So when there's momentum, especially in a trend like this, it usually doesn't fade. And it's cheaper than gold. And gold has had an incredible year. And sometimes investors are thinking about which is the cheaper metal to hold on to, where they've already maybe exceeded their gold holdings, their percentage holdings for the year. You see a lot of activity. Plus, it's got a lot of industrial uses. So silver's a pretty good indicator. Copper as well, but we got to watch silver because record highs don't lie. And when you see those big cup and handle patterns, like Patrick was sharing with us, and those big bases, and you see those continue to rise up and to the right, that shows a lot of momentum. Also, much lower supply than gold in the silver market, and very popular in some countries as well. So let's get to what is coming down the tracks this week. First trading week of the month, first full trading week in a couple of weeks. Here's what to expect this week. It's December, typically one of the strongest months of the year for the stock market. It's been the best performing market of the month of the year for several months because there's a lot of kind of window dressing that goes on towards the end of the year. We talked about it way back in September with Dan Niles, talking about the fact that portfolio managers, especially those that have been bearish for a lot of this year, may be doing some chasing towards the end of the year. That may be one of the reasons we've seen some strength in the stock market. But December, typically strong, and investors also taking advantage of tax loss harvesting, selling some of their losers, and then adding to some of those stocks that have done so well this year. That may help drive the market up as we close out a pretty volatile 2025, but a very interesting one. But then January becomes the worst performing month because of the same strategy, right? Investors sometimes sell their winners, the prior year's losers, and they buy them back at a cheaper price potentially. And January usually not as strong as December, but we'll go 1 month at a time here. And for long-term investors like us, we don't invest on a month-to-month basis. We invest on an every couple of weeks basis. We stay consistent with it. We don't invest necessarily by the calendar, but if you are, just know that December usually strong, January typically weaker. Shouldn't be any different this time around, but anything can happen. All right, let's get to what's happening this week. Today, Cyber Monday, one of the biggest holiday shopping days of the year, not as big as Black Friday last Friday. And Black Friday was big, of course. We spent records amount. The National Retail Federation estimates we're going to spend over $1 trillion in holiday shopping this year. And obviously, Cyber Monday, one of the big days. But don't forget, Giving Tuesday coming up tomorrow. So if you're thinking about giving, give tomorrow, or maybe you get a corporate match and help somebody out. We'll also get some manufacturing reports today, the ISM Manufacturing Index, earnings from MongoDB. And then on Tuesday, earnings from CrowdStrike, the Bank of Nova Scotia, Marvel Technology, Pure Storage, and Okta, and other companies. Wednesday, we'll get that private labor report from ADP. And this is the one we've been paying a lot of attention to since the government labor department reports are becoming 2 months late. So ADP's got a pretty good monthly tracking of the labor market, the private labor market, private hiring, and it has not been that strong. A little pop up last month in October, but it has been weak for the past several months. Pretty good indicator going into the end of the year to pay attention to. We'll also get import prices for the month of September. There's that 2-month-old data from the summer coming back to us, as well as ISM services and PMI, earnings from CRM, Salesforce, what a great ticker, Snowflake, and Dollar Tree, among others. And then on Thursday, initial jobless claims, weekly jobless claims that are coming to us on a regular cadence, kind of holding up. And then earnings from Kroger, HPE, Ulta, and Dollar General. Dollar General and Dollar Tree earnings. I always pay attention to those because that shows the sensitivity of the lower income consumer. And then on Friday, the consumer sentiment preliminary report for the month of December. We know consumer sentiment has been in the dumps. We'll see if there's been any pickup in the last couple of weeks. We'll also get a report on consumer credit and then earnings from Victoria's Secret. And our indicator for this week, as we head into the final month of the year, is implied volatility. Implied vol is something to pay attention to if you're watching the options market, if you're watching the futures market, because this just tells you if you see a rise in implied volatility, how much it's costing investors to get protection against a decline in their favorite stocks. So when you see implied volatility rise, you know it's getting costlier to hedge against a decline in your stock prices. So protection costs for technology stocks are the highest they've been since December. Good chart here from Bloomberg that just shows you stocks may be rallying again and maybe had a good recovery to end last month, and they are up. The S&P 500 some 17-18% so far this year. That rally may seem tenuous to some. That's why you're seeing high protection costs, higher implied volatility, something to focus on. And another way of seeing that is looking at margin debt and looking at the other side of that coin, margin debt versus the Wilshire 5,000. This shows you how many people have been borrowing to buy into this rally. So on the one hand, you have investors who are hedging against it. That's where you see the rise in implied volatility. On the other hand, you see a lot of people borrowing to play into it. And when you have those two forces battling each other, that causes a lot of volatility in the stock market, especially when we get close to potential sell-off or when things get choppy. You see a real spike in the VIX, and you see a real spike in also implied volatility. Good question here coming from Life of Yaz Zero. I have 50,000 spare cash right now. What's the play? Well, if you have debt, my friend, pay that down. If you don't, and you are young, and you seem kind of young to me, I'd make sure that you are invested broadly in the market and also in the growth part of the market. You got the number one asset on your hands besides 50K, and that is time. So I would definitely spread that broadly across 3 or 4 very strong ETFs, high liquidity, right? With some of the strongest, highest growth stocks in the market. And I would also make sure you have some cash for a rainy day fund. And if you want to put some in the bank in a high yield savings account, do that as well. You want to take a risk with just a small portion of that? Go for it, my friend. David asking, gentlemen, at this point, when do we ask, has the metal ran its course? When do we say it's safe for a price reversal? Good question. And that's what Patrick was saying. Patrick was saying, when you see that type of momentum day in, day out, and those types of price increases in a metal that's not that widely held, the market is still much smaller than gold. Well, you know, it's getting a little toppy out there. So I don't know if we'll see a complete reversal, but the reasons that silver has been rallying are kind of the same reasons gold has been rallying. Concerns about rising inflation potentially, but prospects of a potential rate cut that might buffer that as well. Plus demand. People still want the metal. And I know a lot of people that have sold, taken some profits on their favorite stocks and put that in some precious metals just because they want to hold on to any gains that they have had. Any comments on Solana, where it is headed? Is it done? I do not know that market well enough to comment, and I know myself well enough to not comment on things that I don't understand well, but there's a good chart from our friends at Launch Live popping the Solana chart up. That looks not like a very healthy chart to me, but Solana is one of those coins that I just don't understand well enough to comment on, but looks kind of like a dollar chart to me, my friend. So who knows if that is done or not. A lot of policy in the middle of that. Good question, though. FIFA 17. Put that out to the community and see what they have to say. Thanks so much to Patrick Dunuwila for joining us. Remember, if you're not subscribed to the Chart Report or following it or him on social media and you're in to charts, prices, and trends, he is great to follow. Hey, it's Real Talk. Excellent job on the Express Show. First time seeing it. Thank you. Shout out to you for tuning in, making yourself a smarter investor and making us feel good in the process. So thanks to all of you joining us live from around the world. And here we are right in the middle of the Mediterranean in the south of France, the Investopedia Express, live every Monday and on demand on your favorite podcast networks. Thanks so much for joining us this week, and we'll talk again a little further on down the line. A bientôt.